Good morning, everyone, or good afternoon, depending on where you're at. I want to welcome you all to the Q1 2025 ARCR webinar. Thank you for joining us for what promises to be a highly informative and insightful session on the state of the freight transportation industry. We're fortunate to be joined by two speakers from FTR, leading authority in freight forecasting and transportation. First, we have Eric Starks, chairman of the board at FTR. Eric's one of the foremost experts in freight model share analysis and equipment demand forecasting. With a career spanning decades in the transportation sector, Eric is widely recognized for his ability to clearly explain how economic trends and freight logistics impact both rail and trucking markets. Joining Eric is Joseph Tower, senior analyst for rail at FTR. Joseph brings a strong background in market research and economic forecasting with previous roles at Trinity and the consulting firm Oliver Wyman. His work has helped Class 1 railroads, OEMs, and investors understand key trends in rail car utilization, commodity flows, and equipment investment. Please feel free to submit questions through the Q&A box at any time. We'll leave time at the end to address as many as possible. And with that, I will turn it over to Eric and Joseph.
Great. Thank you so much, Jeffrey. Always very happy to join. Love joining these calls, talking through what's going on in the economy, the freight space, the equipment space. So I'm going to share my screen and we will go through kind of what we're seeing as top of mind right now in the economy, in freight, and in equipment. So we're going to start things off by focusing on what everybody else is kind of talking about, what's very important right now, which is the tariff environment. From there, we're going to talk through how the effect in tariffs and other policies ripples through to economic conditions. Eric will cover that. Then we'll talk through first what's going on in freight across different modes, truck, intermodal, and carloads. And then from there, that'll set us up to talk through what's going on in the equipment markets and some risks, opportunities, things to consider as we look forward into 25, 26, and beyond. So with that, I'm going to jump right in and start off with what's going on with tariffs and how we see that impacting both the economy and the transportation industry. So first, we're going to start off with a recap of tariff policy as it stands right now. So going just straight through the list, the reciprocal tariffs that were initially proposed, which were aimed at leveling the trade balance between the United States and other countries, has been paused for 90 days. But in place of those, again, quote, reciprocal tariffs, those are a 10% base tariff was put in place for most countries, with the exception of China, Canada, and Mexico, which we'll talk through in a bit. So those 10% tariffs are now in place. A 145% tariff was levied against China. That was a combination of retaliatory tariffs from the response that China initially had on top of the 20% tariffs that were already in place. However, recently certain exemptions were granted to certain types of electronics, which are now being reclassified as semiconductors, which lowers that effective tariff rate on China from 145 down to about 121%, which is to say for every dollar worth of Chinese goods we import, $1.21 is going to be collected in tariffs in aggregate. Beyond the country-specific tariffs, there's also been broad tariffs levied against steel and aluminum imports, as well as others for autos, auto parts, and then looking at USMCA, some other goods specifically have been targeted. Though for autos and auto parts, and this is the most recent notable development in tariff policy, is some actions to avoid the idea of the stacking of auto tariffs. So for example, if a car part that was subject to both steel and aluminum tariffs as well as auto tariffs, it's just subject to auto tariffs now. It does not take away that 25% auto tariff. So those pressures are still very much there, but it does lessen some of the impact that was being felt for certain auto parts. And then lastly, looking at USMCA covered goods right now, or looking at goods with trade with Canada and Mexico, USMCA goods are exempt for now. That could, of course, change at any moment. But as of now, those are still enjoying the same tariff-free environment. However, all non-USMCA covered goods are subject to a 25% tariff, which is aimed at the immigration and drug trafficking issues that President Trump has identified that came as a result of that, rather than balancing trade deficit. That's at least the justification that was given. The exception being energy and potash imports, which were given a little bit of a break from the other non-USMCA covered goods, brought that down to about 10%. So there's lots going on. It's changing constantly. This is a time-dated stamp for 113. Yesterday, this could change at any time, but that's the way that things are standing now. And then the last thing on how things have sort of changed is just a look at how tariff policies have been adjusting, or how the effective tariff rates that the United States has changed as a result of some of these policies that have gone throughout the year. So in 2024, total tariffs we were in a very close to a true free trade environment of only 2.6% tariffs on overall goods coming in the United States. With the reciprocal tariffs that were proposed, that would have gone up to 24.4%. However, with the 10% base going into place, but the exorbitant tariffs going against China, that effective rate has actually gone up to 29.7%, and then it's floated back down to about 28% with the pause to those certain electronics that were recently highlighted. So 28% from 2.6, substantial increase in the cost of importing goods. And then a breakdown on how tariff rates, how inflation, how port preferences, how surface transportation can change so quickly. It can change so quickly based off of changes that are happening to any of our major trade partners. So any major changes to trade policy with Canada or Mexico, the European Union, or China. This graph is just to say that those all play a significant role in U.S. trade and imports specifically, in that any changes in the USMCA, any changes to China, any changes to the European Union have significant ramifications. It's not on the margin when change happens here. It makes significant notable differences when there's any development in tariff policy for any nation, but especially those four regions: Mexico, Canada, China, and the European Union. And then this is just to walk through a little bit of what we've already talked about. This is how the tariff rates have changed under the current tariff policy for these different regions. So from Canada to Mexico, we've gone from 0% up to 12%. The European Union, also a free trade environment, going from 1% also to 12%. And then China from 11 to 121. And that huge jump is really what's driving that spike in the total effective tariff rates for incoming goods, from 2% to 28%. This assumes sort of everything else equal. This is really just, let's look at 2024, and then let's assume 2024 trade flows and goods demanded is constant, and we just have these tariffs in place. So these numbers can change depending on which scenarios you're looking at, but just holding 2024 constant, layering on top what we know about tariffs, this is what comes out. This is how the math works out. And then the last thing that I'll cover before passing things over to Eric to talk through how this ripples into economic expectations is what impact do tariffs actually have on U.S. inflation. So the total cost of imported goods, again holding everything else equal, is 25.3% inflation on the cost of goods coming into the United States in aggregate. Now, according to the Federal Reserve, about 10% of consumer spending is attributable to imports, either directly or indirectly. And so when you just multiply those two numbers together, you get about 2.5% of additional inflation. That's expected to be as a result of these tariff policies that have gone into place. And then with that, I'm going to pass things over to Eric to talk through implications to GDP, overall inflation, monetary policy, all of that good stuff. So Eric, over to you.
Yeah, the easy stuff. Thank you, Justin. I appreciate that. Great to be here with everybody. It's just such a dynamic time right now we have a lot to cover. So I'm going to kind of blow up a little bit on some stuff we've been doing. Joseph, I'd like to go back to those U.S. effective tariff rates a few slides back that show the annual, I mean, the 2.6 ending 2024. We can go back 2 more slides, I think. There we go. So I want to brag on Joseph for just a minute. So Joseph went through and he collected all of the tariff data that is out there by country, at the, I believe is even at all the commodity level, everything. And so he went and was able to model through and say, based upon what the administration has proposed at any given point in time, what is going on here. And what was really interesting about this exercise was there was no shock for us at all once we looked at ending 2024 up to looking at reciprocal. What became more shocking was once we did the 90-day pause and then the increase for China, it went up, even though the markets were very excited because they're like, oh, great, 90-day pause. This is wonderful. It actually became even worse in a lot of ways. And then they did the electronic pause and the markets even said, oh, this is great. And so, but it even came down to only 28%. So in essence, the 90-day pause really was worse than anything. So it's not just that the effective share rate went up, but then also our expectation is that 90-day pause created huge problems for everybody, because now they're like, they were not doing anything. They were waiting to see what was going to happen. And now it's basically said, oh, we're going to have you wait and see for another 90 days. And that's the problem that we're running into, is businesses are kind of stuck right now. Okay, Joseph, we can go back up to looking at that, what our forecast is for that effective rate. So having said all of that, we had to make a decision, and we said, okay, what are we going to put on our forecast? Because this is such a dynamic market. Well, we didn't use the higher number. We came and we just said, you know what, we're going to use 20%. That allows us to hedge or bet a little bit. It's not that things have gone away, but it's that there's that shifting starts to ease back. So that's what we did. So the things we're going to talk about today is on our forecast, is that's what we used for the inputs here. So let's kind of look at a couple of those items from a forecasting perspective. So if we look at the imports of goods, so what I'm going to do is I'm going to compare what we were saying in March versus what we now are saying at the end of April, early May. And this is looking at the average growth from now to the end of the year. So the second quarter, third quarter, fourth quarter, what were we saying was going to be the average growth rate for those 3 quarters? And what was it before and what is it now? And so that actually, we pulled this number down substantially. Now, this is no surprise because it's imports of goods, right? I think everybody had an expectation that that was going to happen. But the imports of goods also has seen a recent surge. And so the first quarter numbers look really, really good. And so for us, we didn't even have it as high. So the likelihood that they come in a little bit lower than what we're saying actually is there. But all in all, it's not a great picture for that. So let's keep playing this out though a little bit. So what are some of the other implications? Well, the other implication then is that we start to see a higher unemployment rate, that we were saying something around 4%, and now we believe it's going to go up and it's going to peak above 5%. So that creates some additional issues within the labor market. What we don't know is fundamentally, does the labor market stop? Does there become a complete pause in there? But right now we say that there is something that's going to happen within that labor market, and that you start to see higher unemployment. Up until now, autos have actually been doing really good, and people have gone out and they've seen the tariff situation. They said, I'm going to go buy. So ultimately, as we then look forward, what does the auto market look like? And when we look at the auto sales expectations, well, we thought that they were going to be somewhere close to that 16 million range, and they were going to be relatively flat. And now, based upon everything that we're seeing and putting in the tariff impact, then that brings that number down noticeably. So we get below 13 million in annualized sales activity. And that creates an environment where that's less freight in the system. And so the less need for equipment. And so Joseph's going to talk about that specifically as we talk about auto racks. What does that look like? So we're going to have a drop in parts. We're going to have a drop in completed units that are going to be problematic for the industry. And so this takes a little bit of time for us to work that way through. But by the time we get to end of 2026, that doesn't get back to where we were. So ultimately, what does this mean for the overall industrial sector? Well, industrial production had been fairly flat and it hadn't seen a whole lot of growth. We were kind of expecting about 1% growth through the end of the year. And that was not great. That was okay. Now we actually have an expectation that we're going to see it drop a little over 1%. So that's basically we pulled our forecast down from a growth trajectory, over 2%, 2.3%. That's a big deal. And so the talk within the administration is that they want to see more industrial coming back, production coming back into the U.S. The likelihood for that to occur anytime soon is very, very low. There are a few industries that can hit the ground running if we already have production in place and they have capacity. And so that has some possibility. But by and large, we're really not going to see that. The other thing then too is, like I mentioned, that 90-day pause creates other issues too, is because nobody knows what that operating environment is. And with the administration continuing to change their tariff policy day to day, somebody to make an investment, a million, billion plus investment in facilities, basically is saying, I'm just going to wait, because if I start to make a commitment now, that's a lot of money on the line, and that could change tomorrow. So this is one of the big problems. But the consumer then really is the driving force. When we think about the consumer market, that's the bulk of the GDP market. But it doesn't account for a lot of freight. I mean, there's some there, but the bulk of the freight is really in the industrial sector. So the consumer is heavily service oriented, but even then, we still see a noticeable pullback by the consumer. This is that whole thing of, do you have people participating in the economic environment? And ultimately, we're basically saying, no, they're willing to kind of pull back because of this amount of uncertainty. And I think if there could be a lot more certainty about where things are going, what does it look like, I think that might change some of that trajectory. So everything we're putting in here right now is what we understand the things to be at the moment. And Joseph put that, that timestamp on the tariff situation. That never happens. We've never had to put a timestamp on something like that. This shows how volatile of a situation it is and how much of a problem we're dealing with, and that amount of uncertainty. But the $1 million question is, okay, fine. We have things not growing noticeably, but do we, what happens with inflation? So if we look at the inflation environment, and Joseph highlighted, he had that fairly straightforward formula to talk about the consumer. Well, what we've been able to do though is not only that. So he did that using one formula. This other one comes directly from our economic model, and they basically tell us the same, in essence, the same thing. And is that we're going to see noticeable inflationary pressure. So we were thinking somewhere around 3% inflationary pressure through the balance of the year. Now we're looking at somewhere north of 5%. And in fact, if we haven't shown it here, if we did it on a quarterly basis, we would get above 6% for a particular quarter. And so that's a huge problem. So the Fed is trying to figure out, we have a slowing economy and we have inflationary pressure. So that puts us basically in a stagflation type of environment, and they get stuck on what to do. And I've had so many discussions with people about saying, well, we've gotten through inflation before, right? We saw COVID, but the reality there was that was a demand-driven inflation environment. Demand was there, and so prices went up. What we're saying here is demand isn't there, and prices are still going up. So that is the fundamental difference as we look at it. Let's look at a couple, two more items. So real GDP. So GDP numbers just came out. We had anticipated them to be over 1%. I think it was 1.7. We were forecasting somewhere in that ballpark. It was pretty clear that was too high. What we didn't know was how much of an impact imports were going to be, because there was some weird stuff in that particular data, specifically in January, February. But in general, it's, we saw a decline in GDP. Now that happened where we saw imports surge substantially, and that an import number reduces GDP. But it also, from a positive standpoint for GDP, we saw inventories rise, and we saw expenditures for business investment for equipment going up. So you kind of had some offsetting things. And in general, my expectation is that we don't see inventories to continue to go higher. Those start to shrink as we move into the second, third quarter. And then we start seeing businesses pulling back. So yes, you might see a quote unquote positive in Q2, Q3 because of imports falling. Those are no longer going to be growing to beat those tariffs. So we still see that this environment is going to be relatively weak. So by and large, we're really talking, a sub 2% market and closer to that 1% type of GDP market. Now, if we look at the goods transport sector, this is where it went crazy. We saw a huge first quarter. And that really was driven by the things that I just explained, right? Those three items right there explain a lot of it. And the bulk of this is imports of goods, because for goods transportation, we basically add back the imports of goods because it's freight. We want to understand what freight looks like. So right now we have an expectation that those are going to fall over the next 2 quarters. And given the level that we had in Q1, because this forecast does not take into account that number that you're seeing right there, this was run before that, we will definitely see a noticeable fall off in Q2 for the goods transport sector. So this is going to put a lot of downside pressure on this particular market. And finally, let me just kind of end with this and to hand this off with Joseph. The understanding this is really important, because as we start looking at what the markets are doing right now and what the conditions are likely in the future, there's going to be some disconnect between looking at economic data up until this point versus going forward, because there's the time lag is there. So we're already shoving into a lot of the expectations of what we see the market looking like as we go forward once the data comes out. So, and I feel very comfortable with the numbers that we are putting out here. And I think that there is still a substantial amount of risk to a lot of this and a lot of volatility. So Joseph, let me hand this back to you.
Thanks, Eric. So yeah, we're gonna move now into talking through expectations for the freight environment, and I'm actually going to hand it right back off to you, Eric, to talk through the trucking environment, and then from there we're going to talk through the rail intermodal, and then hop over into equipment. So Eric, if you wouldn't mind,
Absolutely,
talking about
yes,
our expectations on trucking.
Yeah. So when we look at the truck market on overall freight, so what we're looking at is truck loadings going forward. We're basically seeing a flat market. We're just not seeing any growth there. Our expectation last month was that we would actually see some growth starting here. And so that little bit of growth that you saw to start end of 24, 25, that trend would have kind of continued. And now it says, nope, that is going to go back down. And by the end of this year, we're going to still feel the pain before we start seeing any type of growth in 2026. So what's going to be interesting is how much pain rail has as part of that. And so that's what Joseph's going to kind of cover. Now, one of the things then we'd look at is not just the freight market, but we look at utilization. So how many trucks are seated with a driver versus those that actually are moving and doing work. Well, that number had been going up, and then it's kind of stagnated. And while it shows it to go up just a little bit as we move through the balance of this year, by the end of 2025, it'll come down. So I think that there's more downside pressure to this as we go. Ultimately, the way to think about this is that if we are at that 92.5% range, then the market is what I would call balanced, meaning nobody has the upper hand. In essence, you basically get back to somewhere between 0% and maybe 2% on rates. And so therefore that pressure starts to dissipate. So ultimately, when we think about the rail market, what this tells us is that there'll be a little bit more capacity later this year for truck than we had initially anticipated. So the likelihood that there's more of a push towards rail and say intermodal becomes harder to see. And I do personally, I think that we're still a little too rosy for our active truck utilization outlook, given what we are seeing with the slowdown expectations within the broader economy this year and within the transportation market as a whole. So I caution everyone to kind of look at this and try to understand that risk parameter as we go forward. Joseph?
Great. Thank you, Eric. So a lot of what we seem to be anticipating in the truck market is what we're also going to be anticipating in the rail market from a freight environment. And that kind of just speaks to when you have a reduction in imports, when you have a reduction in overall economic expectations, that's something that hurts all the different modes. It's not one problem for one mode and an opportunity for another. This is a spot where we're seeing some more softness in all three modes that we weren't sort of before all of this started to unwind. But first thing that we're going to talk through is what's going on with intermodal, which is there's certainly commonalities between carload, intermodal, and trucking, but trucking and intermodal are a little bit more tightly related with the type of goods that they do. Some indicators that we like to look at and the competitive nature between those two is closer. So we're going to start off there and just do a little bit of a recap on what has rail traffic been doing so far this year with intermodal. And it's been pretty bumpy. Conceptually, we know what's going to happen. It's just the timing that's been a little tricky as we've started out the year. So heading into 2025, the anticipation was day one tariffs. And so a lot of what you saw this first month of January, this first month of the year in January, was a ramp up in imports to an incredibly strong January, a month that typically you see much more depressed levels of overall rail traffic. And then things started to moderate from there. And that kind of goes to not only our expectation, but the expectation for most of the industry was day one tariffs, ship in your goods now. Now, that's not exactly what happened. And so we had a few weeks in February where we actually saw year-over-year levels decline. We actually had 1 week of year-over-year declines. But now, with a little bit more clarity on what these tariff policies are actually going to look like, who it affects, we saw that ramp up in traffic as we moved through March, going into the beginning of April, where we had an increased level of imports, both nominally and on a year-over-year average. However, as we've gone through April, we've seen some moderating levels, particularly for the U.S. carriers, where we've seen week-over-week declines for BNSF UP and as well as CSX Norfolk Southern, with the Eastern railroads actually now reporting year-over-year declines, with a lot of that having to do with the demand destruction coming from the tariff policy. Now, while it's CSX and Norfolk Southern that are negative now, it's our belief that it's the Western carriers that are going to be hit a bit harder, and that's specifically due to the impacts to China and how heavily China uses the Trans-Pacific lanes coming in through the United States and Canadian, but especially the United States West Coast. So with how substantial those tariffs are in China, while it's the East Coast that's seeing the declines now and probably will continue to see declines, a lot more of the moderation I feel is going to be coming from the West Coast carriers as we get a little bit further into the year. And overall, as we look out into the year, so again, starting out 2025, we've had some positive year-over-year gains, a slight decline in February. That was due to one, the past expectations of day one tariffs, but then also some pretty wide-ranging weather events in Canada and the U.S. Midwest. And as those gains have continued into April, we're expecting to see another month. Once April data comes out, we're going to expect to see that it was also a month of year-over-year gains. But then after that, it's the expectation that the moderation is going to continue, and then moderation is actually going to turn into year-over-year declines, where overall, with the strength that we had at the beginning of the year, the weakness that we're expecting over the next 3 quarters, total intermodal originations is going to average out to 1% from 2025, far lower than the 8.5% that we saw last year. And then given the elevated levels of unemployment, the continued weak expectations of the overall economy and the industrial economy, we don't see 2026 looking much better, with the total year ending up 0.8%, with both international and domestic equipment coming in at roughly the same level for both of those years.
So Joseph, before you move on for a second, can I just ask a question to address on, if you can go back one slide for a second. So clearly the weakness we're seeing by the end of the year. What is the risk parameter, given what we've been hearing and seeing specifically on the West Coast and stuff coming out of Asia for, say, May, June, July? Is that down? Is it substantially downward that you're feeling, or so I'll let you kind of give some thought on that.
Yeah, so there's a number of data points that you'll see as you kind of read what's going on. The reports are that there's been a significant slowdown in exports coming out of China, that the tariffs are in many ways prohibitive, to where China cannot compete in doing business with U.S. companies, and that it's going to be other countries, particularly those in South and Southeast Asia, that's going to pick that up. And those countries don't use the West Coast as much as China does. And so the reports that I've heard, that I'm going to try to remember some of them off the top of my head. I believe it was the Flexport CEO that said in the 3 weeks since the tariffs were announced, China to U.S. bookings were down something like 60% from that, comparing that 3-week period. And similarly, Trans-Pacific lanes to the San Pedro Bay area, that's the port of LA and Long Beach, down somewhere around 30%. Don't quote me on those numbers. I'm trying to remember from the top of my head, but from what I'm seeing, it's pretty substantial.
No, the LA port basically was saying roughly 34% down.
Okay.
In the next week or two. So then they publicly have reported that.
And then with that, and there's lots of rabbit holes that we can go down on this, but with the shift to other countries, again, I kind of already alluded to it, but some demand is going to be destroyed, but then some of the supply chain, some of the procurement is going to move to other countries. And so depending on how sensitive consumers are to different prices, we could see some gains or some losses to the East and Gulf Coast ports. But again, overall imports are expected to be down, and it's certainly going to be the West Coast that stands to lose more than the East and the Gulf. Okay, and then from there, so that's kind of level setting what's going on with freight for intermodal. Now we're going to talk through what's going on with carloads, and then we're going to finally jump into what's going on with equipment numbers. So total carloads has not had as strong of a start to the year as intermodal did, but we actually saw total carload growth outpace intermodal growth for the most recent week, which was interesting. That's not something you see a lot of. Now, there's a lot of caveats to unpack here. So a lot of the recent growth actually has been driven by coal. So coal is one that I feel like disproportionately dragged down last year. It kind of muddied what the clear picture is on the downside. This year, it's making things seem rosier than they actually are. So last year, coal fell about 12% in 2024, and that was due to what happened at this point in 2024, which was a collapse of natural gas prices and record levels of coal inventories that resulted in coal traffic just plummeting. And so we haven't had that this year. It's been in line with the 5-year average so far this year, which creates these huge year over year gains compared to the weakness that we saw this year. So we've seen much more consistent growth, but a lot of that's been coal. But it hasn't only been coal. So grain has been driving a lot of this. Some chemical markets have been driving this, though petroleum has been one of the ones that's been dragging things down. And then some of the smaller commodities that you'll look at, they'll have certain good weeks or bad weeks. But when you take out coal, when you take out grain, petroleum, the really bulk goods that aren't as sensitive to economic conditions, you get a much more flat number. And that's what we call our economically sensitive freight, where you don't see those several consecutive weeks of year over year declines. You'll see a pocket, or you'll see like a single week of year over year gains, but the overall picture has been down, and that's generally what we're expecting to continue for most of the year. So total expectations for all carloads, this includes coal, grain, and petroleum, is that we're going to have about 1% gain over the year. But though again, remember those commodities that I just mentioned and those kind of nuances to keep in mind. And then going into 2026, with the slight recovery, slight increase in economic expectations, we get a slightly better year. But we're still not expecting to see any type of robust growth. We're not expecting there aren't hardly even any real green shoots to look at. Agriculture, grain has been doing great, but grain is a mean reverting commodity that really doesn't show a whole lot of sustained growth, and it's also one of the most vulnerable to some of the retaliatory tariffs that might go into effect as a result of any type of change in trade policy. Looking at our economically sensitive freight, it's flat this year. So we pretty much have no growth in 2025, and then a little bit better of a picture in 2026, and that's due in part due to coal being taken out of the equation, where we don't see those gains in 2025. We don't see the secular decline that continues in 2026. So overall, the freight environment, both from intermodal and from carloads, is pretty flat. Along with what we're seeing in trucking, there is the weakness in the industrial economy kind of ripples through the whole industry, and most commodities are expected to be flat or down, with really no commodities showing true organic growth that's going to be lifting up propping up the carload or intermodal markets. It's going to be a pretty flat couple of years for total freight demand. So with that, we're going to with a flat freight environment expected with weaker expectations of total equipment, we're going to talk through what happened with the latest ARCI report, and then allude to some of our expectations as we finish out 25, move into 2026, and then even look a little bit beyond that. So, like trucking, we also like to understand how effective is rail equipment being utilized, which is a function of how much freight is moving through the system, and then how many rail cars are needed to move that freight, and then you just compare that to how much freight is actually out there. So how much freight's being utilized versus how much is out there, and that's the number that we're looking at here. That's our rail car outlook. That's our rail car utilization outlook. Now, up until just a couple of months ago, we were expecting that we would see some incremental gains beyond 2025. Looking out beyond, it would become a tighter and tighter environment, not getting super tight, but moving closer to that 10-year average. But with the recently reduced expectations for freight and the economy, we're seeing that we're actually going to see rail car utilization tick down a bit to where it has been hovering for 2023 and 2024. So that gradual tightening isn't something that we're really seeing anymore, besides when we look out into the next couple of months. Looking at the latest ARCI results and understanding how those play into our understanding of utilization rates, it was definitely a weak quarter for orders, deliveries, and backlogs. It wasn't, frankly, I was expecting it to be even weaker than it was. So I was a little bit surprised on the upside, though it was still weak, and we're kind of expecting that things are going to get a little bit worse as we look out into the rest of 25 and moving into 2026. So in total, orders came in at 5,085. And then deliveries came in at 7,810. That was the lowest level of deliveries since the second quarter of 2021 during all the COVID uncertainty and then also all the supply chain disruptions. And this delivery number currently, just taking this number, multiplying it by 4, puts us at a pace of about 31,000 cars for 2025. Though again, our expectations is that there's going to be more headwinds that affect this market as we look forward. And then the backlog, as a result of the low orders, as a result of the low deliveries, but the higher deliveries than orders, the backlog fell again to 31,548, which is the lowest level since 2011. However, beyond just overall numbers, something that we really like to understand is the backlog to delivery ratio, understanding how much runway do the OEMs actually have for building out what's currently in the backlog. Now, last quarter, in the fourth quarter of 2024, that number was at 3.4, which is lower than we like to see. We typically like to see backlog to deliveries at or above 4, which is just to say that OEMs have the capability of leveling out some production, keeping run rates steady. That's good for them. That's good for the lessors. That's good for the shippers. And so we don't like to see that margin getting too thin, because that creates even more uncertainty for future expectations. Now, something interesting happened this year where that backlog to delivery ratio actually ticked up to a little bit north of 4. And that is something, to me, when I see that the backlog to delivery ratio ticked up despite deliveries going down, despite backlogs going down, what I see is that OEMs are going to try to draw out some of their production, again, for the sake of keeping run rates constant, for not having to let go their workers more than they absolutely have to. And so that's something that I expect to continue, is that a car that might have been delivered in 3 months, it might now be pushed out to 4 or 5, just kind of lengthening out that process, a gradual reduction in overall production, just to keep lines as steady as they can. So that was very interesting to see that despite the decrease in deliveries, we actually saw the backlog to the rate, or despite the decrease in backlogs and deliveries, we actually saw the backlog to delivery ratio tick up, which is the first time it's done that in a while. Now we're going to look at what's been going on with the backlog, talk through some interesting trends and some unique risks that this poses as we look out into the future. So this is, again, just a breakout of the current backlog for Q1 from 2021 to 2025. What does that backlog look like? Which cars have made that up? Now, as you look in 21 and even more so in 2022, there's a lot more, and this is something we've talked about a lot, but it's very important to talk through. There was much more diversity in which cars were being demanded. And this served, whether intentionally or not, it served as a little bit of a hedge to certain market risks, where if chemicals were down, that affects one car type, or if any given car type or commodity demand was down, there were still other car types that you could sort of lean on a little bit to not be so susceptible to the market going up or down. It allowed for a bit more stability in things like planning. However, as we've moved out of 2022 into 23, 24, and now into 25, this has become a much more homogeneous backlog where the backlog is increasingly concentrated into covered hoppers and tank cars. And while that's not inherently bad from a overall delivery number, this gets rid of a little bit of that hedge where now if something happens to agriculture, if something happens to chemicals or to energy, there's a lot more risk involved here now that could push things up or down because the health of the industry is much more tied to a smaller number of overall overall car types, which is just something to keep in mind when looking out into the future, is that we are now much more dependent on the health of just a few industries than we were when we looked back in 2022. So now we're going to go through each of the individual car types. I'll go through this somewhat quickly to make sure that we have time for Q&A. We're just going to talk through at a big picture what's been going on over the past 5 to 10 years for each of the individual car types and some things to consider. Starting off with backlogs, looking at deliveries for orders, which gives us an idea of will we see deliveries ramp up or come down. We've seen that for the past few quarters now, the number of orders has come in. For 23 to 25, we consistently saw orders coming in at lower levels than deliveries, though we had what looks like 1 to 2 quarters where orders were actually higher. But in general, you've been seeing that order levels have been coming in below deliveries. That's weighed down on the overall backlog, which provides a risk as we look out into how many cars that we actually expect to be delivered. When looking at these underlying cars, I don't think it's really much of a surprise to see that it's the 60-foot and longer, those higher cube cars that have been coming online, replacing a lot of those 50-foot cars that have been coming out of the fleet. And as you see, with the low orders, with the comparatively higher level of deliveries, there hasn't been as much runway. Deliveries have been coming down. In Q4, we didn't have any deliveries, and we had very few in 2025, looking at somewhere around 250 cars. Covered hoppers, likewise, the orders have been coming in consistently below delivery levels, which speaks a little bit to that risk of having an increased dependence on the health of the covered hopper market. We still have a pretty solid level of backlogs for covered hoppers, but it has been coming down and is one of the things to look out as we go out into the next couple of years. Driving this has been consistent activity in both replacement for the mid-cube covered hoppers, as well as organic demand for the over 5,500 cubic foot covered hoppers, which is primarily going to be a function of the chemical market, though there is some ag products that also fall into this category. So it's been both car types that have been driving this demand, though at least compared to the past couple of years, demand for both car types has been down, especially for the over 5,500 cubic foot cars, which have been coming down in the past couple of quarters, especially when looking at that midpoint of 2024. Open top hoppers, we had very little, practically no order activity for the most recent quarter, and overall they have come in under those delivery levels. Again, and a consistent theme that you're going to see across most of these car types is that orders are coming in below deliveries. That's a testament to the uncertainty surrounding both the tariff environment and the economic environment. So you're going to hear me repeat myself a lot for a lot of these cars because we're seeing a lot of the same themes, a lot of buyer hesitancy, a lot of apprehension to make an investment in a brand new rail car when there's so much uncertainty about what's going to happen even over the next couple of weeks. It makes it very difficult to plan for the next 1, 5, 10 years. And then what deliveries have actually looked like. They've ticked up generally, but this is a pretty small car type. Been averaging about 400 cars over the past couple of quarters. And that's been, of course, all dedicated to steel with really no activity to the aluminum coal cars. Gonds is interesting. So gondolas, they are one of the few areas where there seems to be some level of opportunity for deliveries. Though compared to covered hoppers and tank cars, this is a very small car type, unlikely to make substantial changes to delivery expectations, either for the upside or downside. But in any case, it is one of the few car types that we have actually seen some opportunities come in with a big jump up in orders for the most recent quarter, exceeding delivery levels, resulting in a slight increase in the overall backlog levels. And then, of course, it's been the GB steels that have been driving these recent deliveries, both the Milgons and the covered hoppers. Though there's some really interesting dynamics in what could happen with steel and aluminum, which we can talk through as we get to the end, as we get into the Q&A or to the discussion. Some very interesting factors to consider with steel. Non-intermodal flats. Now, this is one that was a bit of a surprise. And when you look at our last delivery forecast, this was our biggest miss for our most recent forecast. So we had been seeing deliveries of the non-intermodal flats rising, and we had been seeing that the orders were drying up, that the backlogs were drying up. But we were anticipating that, so we knew that there was going to be a ramp down in total deliveries, but we were expecting it to be a bit more of a stair-step function, to where it was after a few quarters we kind of get to what we saw now. But instead, it was a much starker decline in overall order levels than we were previously expecting, with both orders and deliveries both falling pretty substantially in the most recent quarter, and really no indication that we'd see a big ramp up in the near term. Driving that has been primarily the auto racks. You can see that that's clearly what has been leading up to the buildup in overall delivery levels. It's also been the biggest reason for the quarter-over-quarter decline for the most recent quarter, with some limited opportunities also existing for that all other fleet. Those are going to be your general service flat cars. Intermodal, always very tricky to understand what is going to happen in this market with the incredibly limited number of buyers. And so we haven't seen any orders for the past few quarters, with the exception of the most recent, but the most recent was a very small number of orders, and overall delivery levels have been trending down and have been zero for the past couple of quarters now. And it had been the domestic 53-foot 3-unit articulated platforms that have been driving it, but as you can see, clearly no real delivery activity lately. And then lastly, the last car type we're going to go through before coming back on screen, talking about opening things up to discussion, to Q&A, is what's been going on with tank cars. Now, tank cars, like covered hoppers, of course, is one of the biggest drivers of recent deliveries, and is expected to be an even bigger driver of railcar deliveries as we move forward compared to the other car types. Now, we've seen order activity coming in to a greater extent and to a more steady extent than we've seen for many of the other car types, but they have still generally been coming in under delivery levels, which has resulted in decreases in overall industry backlogs, which makes us think there's going to be some decrease in overall tank activity, especially over the next couple quarters. Now, chemicals is one of the few, chemicals and agriculture both are some of the areas that we expect to perform stronger than a lot of the other car types. And so where a lot of the other car types, you're seeing some of these decline from stalling commodity demand, you'll still see that a little bit in tanks. Again, the tide is getting lower, and that affects all the ships, but it's going to be a little bit to a less extent for tank cars. And as we look at what these deliveries have looked like over the past few quarters, it's been the non-pressure fleet, which is more closely attributed. Like there's many more commodities that fall into this car type. You have a lot more chemicals, certain petroleum products, agriculture products that fall into this. That's what's been driving the increase recently in overall deliveries, while the over 26,000, those are going to be primarily ethanol and crude oil. That has been holding relatively steady. And after seeing a little bit of a ramp up in activity for pressure cars, that one has come down in the most recent quarter. But overall, it's not one single tank car type that's driving this. With the vast number of commodities that are moving in tank cars, especially in the commodities that are going to expected to hold a bit more stable than the others. Um, there's been some order and delivery activity really across the three different tank car types. So with that, a lot of this information came from the REO, and with that, we will go ahead and Eric and I will put our cameras back on, and we will go through any questions that you might have about the economy, about freight.
You muted yourself, Joseph.
Oh, sorry about that. Cut myself off. Open to discussion. Happy to take any questions that might have come through.
Thank you, Joseph and Eric. We're now going to move into the Q&A session. We have a few that have come through, but just if you haven't already, go ahead and submit your questions to the Q&A box. We'll do our best to get to everything that's been submitted. First question, supply of goods start to shift from Asia to USMCA. Do you see the mix of rail to truck intermodal share significantly changing? And if so, how?
Go for it, Joseph.
Yeah, so the shift from China to either the United States, Canada, or Mexico, I feel like those opportunities are going to be a bit more limited just by the type of industries that those countries serve. So really what comes to mind that, might shift from China would be certain steel products. There's a lot of steel production that comes from Canada and Mexico, but the steel tariffs that went into place against China have also gone into effect for the rest of the world. Additionally, any type of ramp up in production would be much more of a long-term process. One, because there's uncertainty now, people are hesitant to make a lot of domestic investment, but then just the scale that would be needed to develop a lot of these capabilities. We're looking out beyond 2025, 2026 for those things to happen. And so the much more likely shift from China is not to Canada, Mexico, or the United States. It's much more of what we saw in 2018, which is other Asian countries. And in that case, it switches up what those trade routes look like, but not so much rail versus intermodal. It stays in. They remain foreign imports. They remain containerized goods. It's kind of just how do they enter the country. That's the biggest difference. At least that's how I see it. I don't know, Eric, if you have a different view there.
No, I agree 100%. I mean, really, for me, it's more about is there the shift away from the West Coast? Is that to the East Coast? That's all going to be dependent on where things come from. And to that point, what you were talking about, Joseph, is it coming from other Asian countries, or maybe even comes from Europe? Those kind of things. But all in all, I have a hard time seeing that we see a noticeable shift to nearshoring, and that truck becomes that becomes more of the push. So I just I don't see that as of yet.
Thank you. We have about 1 minute left, maybe time for one more question. How might global economic realignment reshape demand for freight rail equipment over the next few years?
You want to go, Joseph, or you want me to?
Yeah, I'll mention a couple things that are kind of just that pop into mind immediately. So and one thing, and this is a little bit what I was alluding to with the interesting dynamics that go on in steel, for example, is that when you move production into the United States, holding everything else equal, you actually, in many cases, put rail at a competitive disadvantage compared to other modes of transportation. And that ties into, for example, how much steel and aluminum we get from Canada. Now, if you're importing something from Canada and you're moving that on rail, whether on CN or CPKC connecting in Chicago, that's going to be a much longer length of haul to actually get that commodity from here from there to here. Now, if you move that production here, you're less dependent on Canada and Mexico for those goods. Then what you're actually doing, you're shortening that length of haul to move these commodities from point A to point B, which one, it reduces the overall amount of transportation equipment to get from point A to point B, but it also puts rail at a competitive disadvantage to truck because rail is more competitive at longer lengths of haul. And so the way things are shifting right now, and I'll say specifically as it relates to, I'll make a point on carload, then I'll make a point on intermodal. On the carload side, for the industrial economies, a nearshoring environment where we're less dependent on Canada and Mexico, I would say is actually more of a net negative towards rail demand, though there is a case for, okay, what about the intermediary goods? What about the new demand for moving steel ore? And that's a very valid point. But as far as the transportation of the finished good itself, you actually have less demand for that finished piece of equipment. And then for the international space, kind of coming in the United States, and this also ties back to length of haul. If a container's coming into the West Coast, it's on average going to move 2,000 miles to get to the population centers, which are typically west or east of the Mississippi. If now we're producing goods that are coming into the East Coast or the Gulf Coast, then you're much closer to those population centers. Rail is less competitive an option, which again you see it's a net negative to overall demand for rail and by extension the different pieces of intermodal rail equipment. So
It-
overall shifting environment, I'd say it's overall net negative, kind of holding everything else equal.
And I know we're running out of time, but let me just throw one thing because I kind of took also a little bit of that question was somewhat about the equipment itself, too, on how it gets produced, and I think a lot of this is really going to be very dependent upon what happens with the USMCA agreement, and how Canada, Mexico, and the U.S. play together. Globally, overall, I think the steel that Joseph kind of talked about, the types of steel that are needed, those can have some impacts. But by and large, I think it's more about those three primary players. So I don't see a major shift at the moment where you have things coming back into the U.S., for example. But there's just a lot of unknowns. And for all types of manufacturing right now, I'm not overly excited about what we're seeing, only because it's very hard to gauge, is this good, bad, or indifferent? Until we know that, it's really hard to give a good answer.
Thank you for that, Eric. So that brings us to the end of today's session. Thank you again for sharing your expertise, Eric and Joseph, and to all of you for joining us and contributing to the discussion. As a reminder, a recording of today's webinar will be made available to all registrants, so keep an eye on your inbox. On behalf of the RSI team, thank you again. We look forward to connecting in the future and hope you all have a great day.
Thank you, everyone.
Thanks, everyone.